Well, good afternoon. I'm John Sangenberger, and it's been my honor to head the Alumni Relations Office at the Tepper School of Business since 2001. We're so glad to welcome you to one of our favorite annual webinars, our annual Investment Outlook 2023 panel. A very timely one, as the economic outlook is on the front pages of the news, not only here in the US, but across the globe as we face high levels of inflation and concerns over a global recession. Before we begin our discussion, let me offer a couple of announcements. First, we've got some upcoming alumni events that we want you to know about. We've got an event coming up with Dean Beju and Dean Sanders from the Carnegie Institute of Technology Engineering School down in Houston in February. We'll be following that with events in Detroit and Seattle, and then a presidential event with Dean Beju and President Farnham Jahanian in the Bay Area in March. So upcoming events, you should receive emails from us if you're in that area. But if you happen to be traveling, we'd love to have you join us. We also want to encourage you to join us for our annual alumni reunion. We're so excited to have in-person reunions back on campus. The 3s and the 8s, as well as our one-year reunion, will be back. We're getting ready to announce that. We're working with all the committees. Registration will be opening soon. So we're looking forward to April 21st and 22nd, 2023 for Reunion 23 at the Tepper School. Well, now I'm delighted to be able to introduce our faculty speakers today. First, our faculty host and moderator, Professor Lars-Alexander Kuehn. Professor Brian Rutledge ended up being in court for on jury duty, so could not join us at the last moment here, but Professor Kuehn was glad to come in and join us today. So he received his undergraduate degree in Berlin and his PhD from the University of British Columbia. He joined the Tepper School faculty in 2008, was named an associate professor in 2014. He teaches courses in finance and corporate finance to undergraduate, MBA, MSCF, and PhD students. He's an award-winning scholar and received our undergraduate teaching award in 2013, as well as our MBA award in 2021. He serves as an associate editor of the Journal of Finances and on the steering committee for CMU's Master of Science in Computational Finance program. So glad to have you with us, Professor Kuehn. Thank you so much for joining us. Now for our alumni panelists. First, let me introduce Jim Foster from the class of 1986. He's a managing director and serves as a member of the management committee for Greycourt and Company Incorporated. He advises wealthy families and institutional clients on investment strategy and portfolio construction as a member of their advisor team. He previously served as their chief investment officer from 2012 to 2021. Prior to joining Greycourt in 2005, Jim had a long investment career as a market maker in mortgage-backed securities, structure of complex equity derivatives and swaps, and a developer of analytics and simulation techniques. So Jim's had a great career. He started his undergraduate degree in economics from the University of Michigan and then came to GSIA, now the Tepper School, for his MBA or MSIA. He's also taught for a number of years as adjunct professor of finance at the Stern School of Business in New York University and is currently teaching graduate students here at the Tepper School as an adjunct professor. He was also one of our commencement speakers at Tepper in April of 2022. So Jim, so glad to have you with us. After Jim, we've got Michael Germano. He's from the class of 2005. He's head of North America for Newton Investment Management and CEO for their investment management there. He's responsible for building their Newton brand within North America by managing, developing a cohesive global team and retaining top-tier talent. He joined BNY Mellon's corporate development team in 2007, where he was responsible for mergers and acquisitions. In 2013, he relocated to Hong Kong to become the investment management chief finance officer for the APAC region. In 2016, Michael moved to London, where I had a chance to have coffee with him and connect, to head the international strategy group for investment management. Prior to serving at Newton, Michael was the Chief Executive Officer of Active Management and the Chief Operating Officer and Head of Strategy at Mellon Investment Corporation, a BNY Mellon Group company. And he comes to us from his undergraduate degree in management science from RPI, or the Rensselaer Polytechnic Institute, and his MBA, of course, from the Tepper School here at Carnegie Mellon. And next is Lori Heinel from the class of 1992. She is the Chief Investment Officer at State Street Global Advisors. She received her Master of Business Administration from the Tepper School and her Bachelor of Science in Religion from Princeton University. She's also a chartered financial analyst and a member of the CFA Institute and the Boston Security Analyst Society. She's Executive Vice President and Chief Investment Officer at State Street Global Advisors. She leads an investment team of more than 600 professionals globally, and she's a member of their Executive Management Team, Investment Committee, and Global Product Committee. Prior to this, she was the Deputy Global Chief Investment Officer at State Street Global Advisors, and before that, she was the Chief Investment Strategist and Head of Investment Products for Oppenheimer Funds. Before that, she was Managing Director and Head of Investments for Citi Private Bank. And before Citi, she was Global Investment Products Group Head for SEI Investments. Prior to that, she shared, as many do from the Pittsburgh area, Mellon Financial, and began her career at Credit Suisse and First Boston. I'm also very glad to say that Lori served on the Tepper School Alumni Board from 2015 to 2021 and made some very valuable contributions to us then. So, Lori, so glad to have you with us, along with our other panelists. Now, let me hand it over to Professor Kuehn to begin our discussion with our three alumni panelists. Thank you so much.
Yep, perfect. So thanks for having me. It's a pleasure to be back. I did the panel last year. It was fun with a different group of alumni. This year, it's a pleasure to have Jim, Lori, and Mike on the panel as well. I'd like to start the discussion with a small presentation about what happened last year, just as a recap, what happened in financial markets and what happened kind of in the broad economy. So here are my slides. I'm just going to present a few slides. So on the market side, so for the last year, this is daily data going back to the beginning of 2022. We have big losses in the bond market. So here on the right-hand side, you see the ticker symbols for the different asset classes. AGG, that's the aggregate bond market. QQQ, that's NASDAQ. SPY, that's the S&P 500 market. Everybody knows Tesla, Microsoft, Amazon, they all crashed big time, down to 30% for the year. SPY lost 15%, and even the bond market was down last year by 10%. That was kind of surprising because here at the same time, we see the double whammy that both bonds and equity markets crash at the same time. That is definitely surprising because there's typically this kind of flight to safety, that when people sell in the equity market, then they invest in the bond market and you see a negative correlation showing up. And this year or last year, we saw this strong positive correlation between equity and the bond market overall. So when you think about different equity asset classes, the big winner last year was the blue line here, which is the value portfolio. So for the last 10, 15 years, growth outperformed value, but last year we had basically the blue line, the value portfolio break even for the year, and the growth companies, which are the NASDAQ companies, they lost again 30%. Another strategy on the defensive side is USMV, which is the minimum variance of the low risk portfolio. Again, did well because they had they were betting on they were less hit by the losses last year. In the middle, we have Momentum, which also just fed around 20%. So again, value did great. The other asset classes did poorly in the US. And then who was the winner last year was commodity. So like the blue line is the commodity index. And the red line are commodity producers. They did really well last year, and that was obviously driven by inflation. Here on the commodity side, that's the producer side of inflation. But then obviously on the household side, we know the same thing happened. Inflation went up to 6-7%. The Federal Reserve acted strongly by raising interest rates, short-term interest rates, up to 4-5%. So the red line, that's the one-year treasury rate. They're rising the rate in order to cool down the economy. That's definitely working, and everything has been slowing down. We have seen kind of big layoffs in the labor market. Even though layoffs on the tech side have been strong, unemployment rate is still pretty low. So like this, the red line is unemployment rate, peaked 10% in the financial crisis, peaked in 2020 COVID crisis of around 14%. Then there was a strong hiring in the economy. Unemployment rate fell down to below 4%, which is extremely strong. And the blue line, that's the quit rate. So that's the voluntary quit rate on the labor side, which is falling. That means the labor market is cooling because there are fewer people voluntarily quitting their job. That's the blue line at the bottom. So overall, that's kind of what happened in 22 in the market. Now I'd like to turn over to the panelists. and ask the first question. So let me start with Laurie. So what is your investment outlook for 2023 coming up? What do you think? How will inflation, COVID, the supply chain problems, and also the political uncertainty in Washington impact the US economy at the aggregate level? What do you think, Laurie?
Well, first of all, thanks for having me today. It's really a pleasure to be here with all the alumni and students who are on the call. I would say that we would characterize 2023 as a year of transition. Clearly, we don't anticipate the kind of drawdowns that we saw in major markets that we saw in 2022, but we also don't necessarily see markets rebounding sharply, at least not in the first half of 2023. You still have a lot of tension between the impulses that you talked about just a few minutes ago. We still haven't contained inflation. Certainly, it looks as though it's coming off of its peaks, but it's hardly back to the 2.5% that the Fed would like to be targeting. And oh, by the way, while growth is slowing, we still aren't seeing deterioration in labor markets that would suggest that the Fed has to take its foot off of that inflation fighting gas pedal. So we think the first half of 2023 could shape up to be very choppy as the Fed assesses the real-time data, which we think is going to start turning over, starts to assess where they are in the inflation fighting trajectory, and becomes more confident that they can kind of let the hikes that they've already put in place ride out for a while, and that will be enough to cool the economy. So our base case is that we skirt by without a massive pullback, or perhaps even a very light and shallow recession, or maybe no recession at all. But the risks to that base case are as wide as they've been in a really long time.
Okay, thank you, Laura. Jim, do you agree?
Largely, I agree, yes. I mean, I think what we see is that coming out of COVID, you had the strongest balance sheets for corporations and households that you've ever seen. And what you saw last year was, I think, the largest magnitude and fastest pace of rate increases and real rate increases that we've seen as well, at least certainly in my market history. And what's going on, of course, is that the Fed is turning up rates because the only lever that it has to control growth and inflation are rates, because on the fiscal side, there is no support there. The Fed is basically acting on its own to try and deal with this. And when you look at it, the analogy I have is much like, my summer cottage on the third floor when it's cold out in the morning, and I go to take a shower and I turn the knob to the right, and you know what, it's really cold. And so unfortunately, often I will continue to turn it to the right until I'm immediately scalded when the hot water gets there. But then I've turned it so far to the right that I really have to spin it quickly back to the left to try and get things under control. Problem is, I go too far, I get cold again, and it takes a while to reach an equilibrium. And I think the lag time between policy and economic response is considerably lengthened over what people's normal experience of it would be, because those balance sheets were so strong. Coming out of COVID, people's ability to revenge spend and travel, all that, it's taking a while for that to be impacted. And the net result is you see nominal spending growth continuing, you see inflation there. And in most worlds, what the Fed has done would have been enough. We should have already seen some form of recession. They haven't. So this gets back to one of my friend's mom's favorite sayings: anything worth doing is worth overdoing. And I think what we've seen is a great deal of overdoing that's going to play out through this year. And Lori's hitting it on the head. I mean, expectations are that we return to, essentially a pre-COVID normal by the end of this year. But I think the bounds on those estimates are really wide. The uncertainty is high. So, a fairly rocky world. From a market perspective, we don't have a strong view on equities because we think the recessionary effects will impact the numerator of profits much more than people expect. And on the bond side, I mean, our clients are all high taxpayers, so there's a strong use of municipals. But when you can sit in 6-month or 1-month bills at 470, 480, and expected equity returns over 3 or 4 years, or maybe 4 to 5%, there's not a lot of reason to be jumping into the markets at this point.
Thank you, Jim. Michael?
Yeah, I think one thing that I think we all agree on is volatility is here for a while. And I think that's our view, right? That the range of outcomes for 2023 really hard to predict. If it will be slightly positive, slightly negative, it'll probably bounce up and down every month between now and the end. We don't think that the outcomes will be massively up or massively down, but we do think there's a broad range and a lot of volatility through 2023. I'll add that, you know, the sort of an analogy that Jim made, it's sort of spot on to what our thinking is. We think that, one, the Fed has overdone it a little bit, but we also think that we have maybe a bit of an offset in that we haven't seen the full impact of some policy that's been approved, but hasn't actually been implemented. For instance, the Inflation Reduction Act here in North America, we think that will drive infrastructure spending through 2023, which will have an inflationary impact. It'll also continue to put pressure on that you know, the employment and wages and you know, the inability to find service workers. We think that we're going to see sort of a competition of stimulus in the infrastructure spending between Europe and the US on the back of that, which will continue to push inflation up. And so we think, again, it's one of these things where we haven't seen the impact of things that were put in place. One other thing I'll mention is, so we just sort of went through a bit of a sort of a consensus polling. It's the third time we've done it of our sort of 150 research staff, and ask questions like, where do you think do you think there'll be a recession in 2023? And so 70% of the investment professionals now are predicting a recession. And so that seems sort of consensus at this point. I'll just add that when we started doing this in August of last year, it was at 80%, and we did it, it was in between, and it was at 77. So it's falling. In terms of the equity bottom, that's the other thing people like to debate. About 25% of the staff think the equity bottom's already happened. We've got about 40% that think it's going to happen in the first half. And I think there's good rationale around that. And it's related to what Jim said around sort of that, you know, that revenue and earnings impact not really being seen yet. The fact that probably the worst quarter in terms of a year-over-year comparable for these firms will be Q2 when they're reporting. And so if they're reporting that and they're guiding for the rest of the year, and that now the comps are going to start looking a little more favorable, that might be what sort of allows that equity bottom to hit in the first half. Personally, I think that I think it's in, and I think that the Fed will pivot sooner than consensus, but I don't have a crystal ball.
Mm-hmm. Interesting. Yeah, thank you. Lloyd, so coming back to monetary policies, what is then your outlook for monetary policy for the next year? Will they raise it more? Will they taper it? Will there be the famous soft landing, or like?
Well, so first of all, we don't think they're done. We actually think they are likely to raise again in the first quarter, but likely not the big 75% chunks or 75 basis points, I should say, chunks that we've seen over the last couple of hiking cycles. And they've signaled as much. And then the real question is, do you start to see enough of that inflationary impulse coming out of the system to basically put them on pause? But we actually think as we head into the back end of this year, they're going to be cutting rates. And the reason for that is because we don't think that inflation has gotten out of control at this stage in time. We think there are natural calibrators that are going to bring it back down into a much more reasonable range, perhaps even as low as 3 or 4% by the end of this year. And those are things like, think about housing. I mean, the way that housing prices transmit into things like CPI is through this owner's equivalent rent kind of calculation. Well, those are things that pass through with a very long lag, something like 8 to 10 months. And those are things that are starting to go the other way as we see housing prices start to fall, that we think will be a natural calibrator that will bring those inflation impulses down. The other thing is that inflation often just runs out of steam, right? It's one thing to say you get a oil price move that goes from $30 a barrel to $100 a barrel, but it's unlikely that it's going to go back up to $200 a barrel and repeat the kind of inflationary pressure that you saw over the last year and a half or so. So there are natural things that we think will work to bring inflation down. And our best guess at this stage is that the Fed is actually already behind the curve and recognizing the impact that their rate hikes have had, and that they may actually have to ease more quickly than markets expect.
Mm-hmm. Do you follow the inversion of the yield curve? Is that an indicator for you, Laurie?
Well, it is, but the yield curve inversion in and of itself is not that interesting. Because, well, so what do you look at? What we care more about is the 3-month 30-year inversion or the 3-month 10-year. Like a lot of people look at the 2s, 10s and things like that, but we actually care about the 3-month because again, that's the rate that the Fed actually does control. It's not the 2-year. And clearly we're in restrictive policy making right now. If you look at just where real rates have moved relative to they were, a few short months ago. So you're already seeing the bite. The issue is that, and because of a lot of the things that you talked about at the outset here, consumer spending, pent-up demand, revenge spending, whatever you want to call it, plus incredible supply side shocks, right, all throughout the course of 2021 and into 22, that's what really drove a lot of the inflationary pressures. Well, those things are already abating. I mean, if you look at consumer balance sheets here in the US, for example, they've spent most of that pent-up savings. Now, look, the inflation picture is still pretty attractive. Most people can still get jobs. So we're not worried about the consumer at this stage in time, but they hardly have that opportunity to just spend, into oblivion that they had not just, that many months ago.
Yeah.
Mm-hmm, mm-hmm. Jim, you commented on the connection between fiscal policy and monetary policy a little bit. What are your thoughts along those dimensions?
Well, first off, I think the much of the problem could have been dealt with by a fiscal partner that actually cooperated with the Fed. Much of the increases that we saw, in part, not general price inflation, but certainly what we saw in energy, and those impacts are policy questions. They're not your usual kind of economic analysis. I think what's very interesting in terms of Fed action is watching what happens to real rates, right? Because at this point, how if they do move to a point of easing because their tightening has been effective, it's going to be to either maintain or slowly reduce real rates. Now, that can happen through the nominal rate, or it can also happen through inflation expectations. And I think one of the things that's very important to note is that, if you look at housing, there aren't enough. If you look at employees, there aren't enough. So even if you beat the economy into a recession, once you start to simulate it back, that's like the birthday candle that you blow it out and it keeps coming back on, right? You have not eliminated that problem. And if you look at the sheer amount of nominal spending, because of the income that was generated from people being hired and so forth, wages going up, there's a tremendous amount of pressure there that the Fed has to fight. And I think they are likely, quite honestly, to continue to push for a 2% inflation level, because if they back off, it's kind of, are they going to act like the Fed in the 70s, or are they going to act like Volcker in the 80s, right? Are they going to be massively accommodating or vicious in their response? Well, if they do back off too quickly, what you're likely to see if they let inflation stay at 4%, for example, is a reset of expectations. And when consumer expectations reset to a 4% level, that's the worst possible outcome for them. I think it's a tremendous credibility hit to them. So when you don't have a fiscal partner that's helping you, when you're doing it on your own, your only tool are rates, and you're worried about credibility, I think there's more room for them to overdo still than to actually manage it smoothly, because they have so much on the line. I would much rather be known as a Volcker than, Burns or someone from the 70s. I think that's kind of the way people look at it.
Mm-hmm, mm-hmm. Michael, what are your long-term outlooks for monetary policy?
Right. Yeah. And I think so. Ending the year sort of where we are today is the firm's long-term outlook, or short, I guess, 1 year outlook, right? So we actually have sort of the 10-year at 3.5 by year end, and the Fed funds at 5%. Like I said, personally, I think that the politicalization of the Fed, for lack of a better terminology, I think if we do start seeing some real hurt to the American, consumer, whether it be, continued sort of stock price declines or unemployment levels that pick up, or more than a mild recession, I think that we will see the Fed pivot sooner rather than later, despite maybe what the inflation targets would have said, or what those metrics would have meant 6 months ago. The one thing I'll point to that I think maybe people will be thanking the Fed, at least sort of from a U.S. political angle, is the sense of the layoffs that we are hearing about right now, right? They're the white collar sort of work from home tech workers, and we still can't get employees in the service industries to staff enough to keep restaurants open and things like that. So it certainly has had a little bit of a social impact that I think people are clamoring for with the recent Fed actions.
Mm-hmm. The labor market response is often pretty heterogeneous across occupation and skill levels. So you're right, Amazon lays off 10,000 workers. That's very different than having somebody in the service industry having that, because they're not shifting, obviously.
Right.
You're stuck in some sense in your occupation. And there's very little mobility across occupation groups. But if you just look at the aggregate level, then obviously the labor market looks very, very tight and very congested overall. Yeah. So let's think now about the portfolio implications based on your outlook. So like, where do you position your clients? Well, what's your outlook? Where do you see like a rotation from more into value happening, from growth to value? Is that continuing this year? What is your outlook, Lori? What's your go-to portfolio? What's your advice right now to your clients?
Yeah, so I'd say the first thing is that we've been doing a lot more active trading around the sort of 60-40 bogey, so to speak.
Yeah.
So our tactical asset allocation portfolios would typically be roughly 60% equity risk assets and roughly 40% fixed income, with a very small allocation to commodities and no allocation to cash. And I would say that over the last 18 months or so, we've been all over the place. There have been periods where we've been way overweight equities, such as middle of 2021 and into the early parts of 2022. There have been places where we were pretty dramatically underweight equities, which we had been in much of the summer and into the fall. And then we're slightly overweight equities at the moment. But interestingly, it's also within those asset classes how we've been positioned. And we've actually not liked large cap US at all, in part because of the double whammy, both the concerns about inflation and strong Fed and the damage that might do to businesses as they have to deal with those inflationary cost pressures, changes in buying behaviors. Like if you look at a lot of the large hyper growth stocks that did well in the recovery phase, they were priced to perfection, and clearly you could see that the demand was going to tail off. And then, oh, by the way, higher rates means that you have to discount those long duration assets at much higher rates, which by definition implies a re-rating there. So we were pretty negative on US equities, even when we were overweight equities as a complex. And where we favored instead, which I think was a bit contrarian, although obviously more people are kind of flocking here, is in Europe. We actually thought that the European impact from the war was not going to be as great as many thought. We didn't think they were going to have the kind of energy challenges. We thought they were kind of getting ahead of that in terms of procuring other avenues to replace energy for the winter. And luckily, they've also had a mild winter. And we also think that Europe will be a bigger beneficiary from the China reopening than the US. So it's been a kind of a trading type of environment for us, but right now we're overweight equities, but not in the US.
Mm-hmm. So you're going Europe and international, you're going global.
Developed international, Europe and Asia. We actually like Asia as well, but just again, in the interest of time, just wanted to share the one example with Europe.
Mm-hmm. And are you still bullish on commodities, or do you think when inflation?
We have a slight overweight to commodities. Commodities is one of the only sort of, not that it's a pure inflationary play, it certainly is not, but it's one of the only things that's highly correlated to inflation pretty much all the time. So we actually did have a position in commodities, an overweight position throughout pretty much since early 2021. And we've retained that, though there again, there have been times when we've added to that position or taken a little away. And then cash has been the other big wild card. Like we, at one point in time in our portfolios last year, we had about 15% in cash. And that was both, we could get 3.5%, 4% at the time. And we were pretty concerned about valuation levels, particularly in US equities, as I described. And we also just did not think fixed income was giving you, you weren't getting much incremental return either on a rates or a credit basis to justify the risk.
Mm-hmm. Very interesting. And Jim, what is your advice to your clients?
Yeah, well, I think, we look at the returns to assets essentially as investments that should generate equity-like returns, ones that would generate fixed income-like returns, and what would be diversifiers. And, you know, in equities would be standard stocks, but it's also private equity. It would be private real estate, things like that. Fixed income. Most of our clients, all of our clients are extremely wealthy. They're maximum rate taxpayers, those kinds of things. So there is a focus on municipals there because of the after-tax benefit. And as a protective asset in a crisis period, you know, municipals will go down, but not as much as everything else. Your best protective asset in that environment is obviously to own a treasury bill because the flight to quality they actually will appreciate. But so as we look at forming a portfolio across those kinds of assets, you know, our allocations to private equity for clients could be as much as 20% of a portfolio in private equity, private real estate. That tends to be more niche-y, more opportunistic. And, you know, we'll spend, if it was new money, we would spend 7 years coming up to target. So we're diversifying by vintage year, all those things. On those kinds of programs, you keep going, because if you're investing in things that create value and you've sized them properly and you've spread them out, you know, bad times are an appropriate time to be committing because, you know, you're buying assets at much cheaper levels, you're creating assets at much cheaper levels. So that's in place, but it's a very kind of opportunistic approach to how we do that. On the protective asset side, you know, a lot of people talk about, you know, they think stocks, bonds, but we're in a world again where it's stocks, bonds, and cash. And when you look at a curve on treasuries that, you know, you're 477 in 6 months, 470 in a year, you're probably on a 2-year note, you know, high 3s, 4, something like that, 4 level. You know, you're actually seeing the short end of treasury curves very attractive. And in a world where, you know, if you think there's a deeper recession than people expect, that clearly means that cash flows haven't been discounted down enough in terms of pricing. Risk premium will go up in the denominator. And, you know, having that kind of reserve that appreciates is perfect, because what we want our clients to be in a position to do is to supply liquidity in a crisis rather than demand it, because that's, you know, it clearly gives you the opportunity to drive great pricing and really take advantage of others' needs for liquidity. So, you know, we've maintained protective assets at higher levels, both municipals plus treasuries. Our private equity kind of private market stuff is basically intact. Across equities, we have been under our strategic targets generally. At this point, we would probably be closer. Again, it's Laurie was talking about a base case, a bear case, those ideas. When you look at kind of a probabilistic pricing, you know, small cap looks attractive. World ex-US, or certainly non-US developed, looks attractive. We'd be underweight in emerging or in the US generally, except for small. And we've had a large emphasis on diversifiers, because what you saw in 2022, when stocks and bonds positively correlate, you're in an inflationary environment. And there's a variety of assets depending upon growth or inflation kind of regimes, which will perform well. It's tough to know. But when you look at the environment we've been in, you know, certainly real rates going up cause risky assets to go down. So portfolios that were long or short, shorting portfolios, even shorting the nominal curve as an inflation hedge, there's lots of opportunities in the diversifying set of strategies to actually offset some of what would be getting beaten up in a 60-40 mix. So long answer to your question, but fine in private markets, probably underweight to maybe target weight in some parts of public equities, certainly a strong mix of diversifiers and a mix of tax exempt, shorter. We didn't want the interest rate exposure. You weren't being paid for it on the curve there. And certainly a good mix of 6-month, 1 month. You ladder 6-month, 1 month, and 2-year bill notes and have a very effective portfolio if the bear case realizes. Otherwise, you're earning, you know, you're earning 4 to 5%. Again, when I said public equity exposures, probably, you know, depending upon your view, 5 to 7% over the next 2 to 3 years. So it's, you know, it's not a bad move at all to move towards cash.
Mm-hmm. How did the muni market do last year? Was it also hammered last year?
Beaten up, but what you see is as rates start to come off. I mean, no one thinks tax rates are going down. And in terms of credits, you absolutely have to be smart in your selection of credits. But as rates come off, you're seeing already a race of people back into muni funds and so forth that's driving it. So, you know, again, from the perspective of a very wealthy investor, 50 plus tax rate, the after-tax benefit of municipals in that range properly managed is a very useful protective asset in the total portfolio.
I agree. And Michael, What do you hear from your institutional clients?
Hearing from institutional clients, yeah. So when I'm out talking with sort of our US client base, mostly public and corporate pension funds, right? It's been that consistent message over the last couple of years with that focus on privates, and the recent conversation has been sort of a little bit more of a debate, right? On one hand, really touting the benefit of the lack of volatility that they've seen holding those private positions, and the debate that's been in the happening over the last few months is how realistic is that, right? The first half of post the volatility in the public markets, it was fine. It's like, oh, we really like this lack of volatility, the lack of the mark to market on a private portfolio. As it continues to go on, I think that some are starting to question, okay, well, when do we have to sort of face reality? Because on one hand, you could say, well, that's the benefit of the private position is, I only have to care about the future cash flows and the discount of those future cash flows. But to some of the points that were made here, well, the discount rate should be higher now because interest rates are higher. And I don't know that the earnings growth is what it was. But the other interesting and maybe sort of unintended consequence of that is for these, especially public pension plans, they have sort of set guidelines of where they're supposed to be allocated. And now because their equity, public equity positions have been marked down with the market, and their private equity positions haven't, they're under their guidelines and where they're supposed to be. So really starting to have those conversations with them about, their interest in what I find really interesting, even going back to when I was at Tepper, right? And the academic pieces over the last 20 years that basically say active public market investing is dead because, net of fees, it'll never beat its passive benchmark. And, over the last year, I can now point to a few of our active managers that net of fees have absolutely outperformed their passive benchmarks. And so for the first time in my career, we have institutional US clients wanting to have conversations about these what were traditionally, active stock picking public equity products.
Well, to the extent that you really increase the cross-sectional volatility and stock returns, it becomes a much better environment. The whole period post Great Financial Crisis, QE, and then what you saw post-COVID basically eliminates any significant dispersion between winners and losers. So cheap beta is your best play. But as you get much more cross-sectional volatility, and think of the amount of debt that people had coming out of COVID, the number of balance sheets that should not have survived except for government support. If you do get recessionary environments, selection really matters because there are a huge number of companies that have no right to exist short of having been supported. So, from that perspective, active managers who understand value creation and understand how to exploit the cross-sectional volatility, particularly if it's even long short or biased long, that becomes very useful in portfolios at this point.
Mm-hmm. So what do you think about kind of quality investing on that dimension, Jim? I mean, that's a little bit ambiguous concept, quality, but it kind of became popular over the last 5 years, I would say.
Right, but it goes back. Lori made the point about long duration cash flows. I mean, if you look at an equity by its duration and rates are moving up, the last thing you want to own are massive growth environments companies. And if you're in a world where you really don't know if you're going to go into a deeper recession, I'd like firms that have much stronger free cash flow, the ability to finance themselves, and really the ability to take advantage of their competitors by investing in a terrible point so that when they come out, they're much better positioned. So stronger companies, stronger balance sheets, higher quality in that sense can be a very attractive component of a portfolio.
Yeah, I just want to jump in here though too, because I would agree with everything that Jim said. I would also say that the nature of tactical or active management is different than it was even just a few short years ago. You see a lot more asset allocators at the kind of micro sector or subsector or industry level tactically allocating. And you could have made a lot of money by getting some of those sector calls right over the last couple of years. Similarly, I talked a little bit about the asset allocation process that we go through and the fact that, we're looking on a monthly basis or biweekly basis at where do we want to position on a relative to each other kind of standpoint. So I think this has been an environment where, because of a variety of the crosswinds, not least of which is this idea of dispersion, that if you can get some of these calls right, and if you can kind of and do your analysis and understand like what are the value drivers, you can actually tactically allocate or actively manage across a variety of dimensions of the portfolio and get it right.
Yeah, a good example of that for us would be, typically in a highly efficient asset class, large cap, let's say, we would tend to have a tax aware passive approach. Now that might have an underlying benchmark that's fundamental, equal weighted. It doesn't have to be cap weighted, but the whole point there is that we're trying to realize short-term losses through time and harvest them because they offset gains elsewhere in the portfolio. But when you see certain sectors get blown out, so for example, biotech getting really decimated, we actually did step in. Now we would view that as planting an acorn in the portfolio. You might size it at a 1.5 or 2% position, but if you've identified an active manager before you get there, them who have skill in that space, and you see the kind of decimation that's happening there, that's a great place to step in because you're potentially acquiring assets at a very cheap price. And again, lower price, expectation of better returns. So we absolutely try to do that where we see those, big valuation hits happen across the market.
Laurie, do you see like more technology also kind of impacting the investment process? Like stated using more AI and machine learning tools?
Oh, absolutely. Absolutely. Look, I won't say that we're at the chatbot, level in our stock picking at this stage in time, but certainly within our active teams, we've been using, variations of AI and machine learning for quite a number of years now. In some cases, it's really basic things like being able to do textual analysis or things of that nature so that we can leverage the work of the researchers and portfolio managers to focus on areas of, real wealth. Versus having to go through transcripts and things of that nature. But, increasingly the holy grail, right, is to get these things to make more of those decisions. I don't think we're quite there yet. And, again, we would argue that you might not ever get there, that the marriage of machine and man or woman in this case is actually the most powerful combination. But absolutely looking to deploy technology in all its many forms across the platform as much as possible, both to drive operational efficiency and effectiveness, but also to let our employees focus on those things where they can truly add value.
Interesting. Yeah. I mean, in general, AI came along from the computer science side. I mean, and there was kind of, let's say, predicting cats versus dogs. And I think the big problem is there that, there's always, so when you try to predict cats versus dogs in terms of images, there's a true answer. But in financial markets, if you're trying to predict the future, whether it was luck or skill predicting the future, but whether it was predict inflation or the stock market in the right direction, like exposed.
But let's be careful about this, right? Because one of the things, and again, I'm not a chartist, so maybe one of my fellow panelists here is a chartist and they can convince me otherwise. But the whole point of some of these technologies is to recognize patterns and then to be able to trade against those patterns, right? And look, we think that certain markets mean revert. But take high yields, for example, right? You have all these charts that you can look at that show that there are periods where high yield spreads blow out massively, and then they revert back to much more traditional, 300, 350 basis points. But the exact timing when that's happened, the ability to get whipsawed, how long they can stay low, what the impulse is, like those are not necessarily things that are easily modeled. So I think there's this maybe a naivete that somehow if you can divine all the patterns that people have looked at in markets before. The other one, just really quickly, we always talk about how it's such a shock that bonds and stocks are correlated. Well, actually, if you look at rolling periods, they tend to be more correlated more often than they are uncorrelated. So if you think about the whole of the post-GFC era, they've been correlated. They've been correlated because they've both been going up. And now all of a sudden we were in this environment in 2022 where they both went down. So everybody focuses on the fact that they're correlated. Well, that's another one of those things that, again, the intuition and how you would actually deploy technology doesn't always align with reality.
Yeah. Yeah, no, Lars, I think the issue for us really, it gets down to diversification, right? Because in our portfolios, to us, diversification is an explicit admission that we have no idea what's going to happen next. Right? If we did, as Markowitz said in his Nobel Prize, if I knew what it's going to be, I'd own one asset. But the diversification question for us is that we know in different types of economic regimes, growth, inflation, however you want to look at them, that assets behave differently. Their correlations change, their expected returns change. And so for us, the goal is how do you build a resilient portfolio? You're trying to satisfy the consumption needs of that that family, right? You're trying to deal with generating real returns over time that expand the purchasing power of that family. So understanding in some sense the likelihood of different types of environments where assets are going to behave differently. And you can certainly do that looking at inflation assets. There's different environments for when they work well, whether it's tips or bonds or commodities or commodity equities. If you can get some sense, a slight edge, then what you can do is construct portfolios that actually are more resilient, maintain the consumption better, and make the ride for that risk taker easier. And that the big part of that is that you keep them from making, huge mistakes, going to cash in a crisis, all those kinds of things. So yeah, there's no way you can get it right, but to the extent that you can edge what your thinking is in a portfolio and more intelligently combine offsetting kinds of diversifiers, theoretically, you do a better job of serving the client.
Mhm.
I'll just add a couple points here that I think Gloria hit on as well. Like man plus machine is sort of the answer, right? And so where we're sort of structured in our different teams, right? We have a quant team that's a very systematically driven multi-asset macro level quant team, and they're using their quant tools to analyze hit tons of historic data, right, to the point, trying to find those trends. But then it's the output of those, how it's organized, how it's analyzed by the human portfolio managers, and how that helps them inform their decisions in the allocations and how they tweak those models. That's where we see that we're adding value. On the quant equity side, right, that's where we have the vast number of sort of industry experts that are doing that equity research. Well, the quant equity team is there to help give them tools to. And as that gets further developed, and as we can use natural language processing and AI tools, it's not about replacing those fundamental analysts. It's actually analyzing the work of those fundamental analysts and where they get things right and where maybe they got it wrong, they held too long or sold too early. And trying to say, where's the pattern there? And by the way, hey, you bought this company and it worked out well. Here's a few other companies you didn't look at that really look like that company. Maybe you should be focusing on them. That's where I really see the ability to add value right now.
Mm-hmm. Mm-hmm. Interesting, yeah. So let's talk about a few asset classes. So Newton is known kind of to be a leader in the ESG investment front. Where do you see the ESG market going for 23? Do you see like a big inflow again, continuing?
So what I'd say is it's evolving, right? ESG is not one thing, and that 2022 certainly proved that, right? And what I predict, right? When coming in January 2022, I don't think it would have been controversial to say sort of oil and gas refineries and weapon manufacturers wouldn't really make the list of an ESG investment. Fast forward to post the Ukraine invasion, and it's, hey, we have to have energy independence from folks like Putin, and we need defense contracts and weapons to sort of defend and keep global peace. All of a sudden, ESG and sustainable, investors are looking at those firms. So it's absolutely something that has evolved drastically over the last year. I think will continue to evolve. The one thing that I'll talk in terms of outlook for 2023, and I'll focus on the U.S. for a second, right? In the US, it's very politicized, right? Like the conversations we have with a client in sort of a California or Massachusetts, very different than a client in a Texas and in Oklahoma. And the proof point I like to point to in terms of how politicized it is that sort of, industry famous letter from the Texas Attorney General listing the funds that, no public firm in Texas can do business with because we supposedly veto oil and gas companies. Well, two of our funds are on that list. Both those funds own oil and gas companies. So it was purely politics. What I'd say is, I think you will, because of performance, in the short term, a lot of those ESG sustainable strategies had a lot of tech exposure, and the tech sort of industry went through a market drawdown, and that hurt a lot of those sustainable strategies. Energy, commodities, some of the best performing last year. And so that focus will lead people to sort of de-emphasize, I think, the E in ESG over the next year. And in the US, I think you're going to see this year is a focus on the S and some of the social movements and products around that. I think starting to be launched. I think long term, it's a trend that will continue. But I think right now the performance dispersion is definitely going to take, and that's coming from a shop that is focused on ESG.
Yeah.
Jim, before we...
No, I think, there is nothing that says a Quaker college must own a weapons manufacturer, right? I mean, so I think the recognition of values and fidelity to those is baseline. The first place that we come at and looking at it as an investor is to understand what factors are actually priced in the market. And, if I'm looking at water and I'm comparing two companies where water is a primary input to the manufacturing process, one's in a drought area, one's not, and there's differential prices of water, for example, if you're in Southern California versus being in Michigan, that's a material piece of data that should be reflected in GAAP accounting because it drives value. So, there's no question that those kinds, if you look at the history of GAAP and reporting and the data there, basically it evolves when people recognize that something actually does drive the valuation of a particular entity. That's perfectly fine. So from that vantage, we look at it, we think about it very carefully. Interesting that when you start to move to the broader kind of ESG labeling in public markets, especially, one of the things that we stepped out to do was, all right, if we're going to do this with clients, how about let's first understand the firm itself, what its values are, whether it's faithful to them, and can it represent that? And if that's important to a client, that says something about who they want to partner with, to do business with. The second part, though, was to ask them, did they apply or have separate ESG strategies, criteria, things that they actually deploy against the strategies they manage, their portfolio products. And it's very difficult to find firms that actually do themselves as well as their respective offerings. You have dedicated firms that have come from a socially responsible investing from, even in the 80s, 70s or 80s, that they have that. But so you see a great deal of greenwashing in the industry. And I think the SEC is coming after representations that aren't fair. And I think that's an exceptionally healthy trend, because it ought to be the case that if people have values, they should be recognized. We should understand how it impacts value and wealth over time. Many of the factors people care about aren't priced, so it's no big skin off your back to do it, because long haul, that indice and other indices will perform exactly the same, nothing statistically different. So the real interesting is when you get into issues of private markets and impact investing, there are actual elements of value creation that are distinct, that can be very interesting to explore, and they may be exploiting things in markets that haven't been recognized. In public markets, a lot of our attitudes say wherever the flows have gone, avoid. Because if all the money went there, that's the last thing I want to buy now. It's been bid up. So to some extent, if it weren't for values, I'd be looking at an orphans index, because so much investor flows have gone towards ESG products that I'm sure those factors have been bid up, and I might, as an investment matter, want to consider elsewhere. And one last point on that, the way we've done things in the past, for example, if we have a client who's very interested in solar, but the solar projects themselves are highly dependent upon subsidy, we'd prefer to invest in venture capital and other things that are businesses selling to those entities, because then the surplus, the tax subsidies and so forth, we capture that in the value creation of our investments, and we're not acquiring an asset that's massively overpriced at that point.
Yeah.
And maybe just the only thing I'll say is I'll kind of connect my answer to one of the questions that's in the Q&A, which asks about views on autos and electric vehicles. And I think that's exactly the point, right? That all of a sudden now you can't look at an automobile manufacturer without asking them, what is your EV strategy? And maybe the answer is they don't have one, and they're going to be extinct in 50 years when everybody's driving nothing but EVs, and that could be perfectly appropriate for where they are today in their cycle. But I think that's the way we think about ESG. It's not really a sidebar thing anymore. It's like it's integrated. You have to consider all these ESG considerations alongside all of what were the traditional financial material factors. And that's, consumer preferences, it's regulatory preferences, it's, things around, how companies are adapting and transitioning to future environments. So those are core to how you think about an investment at this stage in time.
Mm-hmm. I agree. Lloyd, last 5 minutes. So what do you think about the crypto market? So last year we've seen a big explosion of FTX.
Yeah, well, so I'll just share a personal story. I first got introduced to Bitcoin in 2012 by my then, teenage daughter who was mining, and I think she had the success of mining 3 Bitcoins, which, by the way, she lost as she traded computers over the last decade or so. In any event, I always thought this is ridiculous. You could just sort of manufacture money out of thin air, and I still feel that. And in fact, I would say I would represent the firm's views in saying that we think it's a highly speculative asset at best and not ready for prime time as an investable kind of an asset class. Having said that, I think the concept of blockchain technology and the sort of use case of a digital currency is actually quite interesting. But Dogecoin, Bitcoin, Ether, pick your favorite one. There's nothing that underpins them that provides intrinsic value from our vantage point.
Mm-hmm. And you can view Bitcoin as a replacement for gold, the modern version of gold, just to store value.
Well, again, you could argue that gold at least has some central banking backing, right? That the dollar's backed by the Fed and gold is backed by all the central bankers, right? We're not sort of in a world where we're pegged to gold or anything of that nature, but there is at least that kind of infrastructure support. And then, oh, by the way, gold is a girl's best friend, so at least it has some intrinsic value, even if not for investment purposes.
But it's all a choice as a society, I guess. I mean, choosing gold over.
People make that argument all the time, right? They make the argument that Bitcoin is just an alternative for gold, but again, I'm only sympathetic to that in the sense that it's a non-fiat currency exposure, right? But again, there is nothing underpinning some of these cryptocurrencies from our vantage point, from my vantage point, other than the willingness of someone else to see value in them. And that's always a dangerous place. You're in a bartering system, you're in a collectible system, you're not in an investment system.
I agree. In the US, in the US, in the Western world, there's no need to have another currency because the US dollar is so liquid, the euro is very liquid. But if you go like to African countries or like countries with less developed financial markets, they're often the pitches, allows them to store value. It allows them.
Well, and again, keep in mind that part of the reason, and this is actually a good point, because one of the arguments I was very sympathetic to in the past, and still am to some degree, is you go to places like Afghanistan, you go to places like you said in Africa, where the currencies themselves are baseless, right? So there isn't, so in some sense, what are you competing with? Well, again, you're competing with a barter system, you're competing with a collectible system, you're not really competing with a global economic system.
Yeah, it's all about trust, basically. What do you trust? And the Western world, at least with central bank, we trust, and that's not offered by certain countries. Yeah.
I would say the same thing. We look at, if I can't figure out something is worth, what should I pay for it? Why should I buy it? It may certainly have utility. The blockchain comment's completely right. You look at contracts, things like that. There's a lot of applications for that are very interesting. I mean, unfortunately, some of those contracts embed cryptos inside them, which makes them problematic, but and there's a variety of issues that have happened with them over time technologically. But I think, cryptocurrencies, generally speaking, it's much like, if I've seen flows go somewhere and now those flows are gone, what's the floor? If the Fed drove investments into bonds and other markets and those investors leave, well, okay, what's the natural bid once they're gone? I don't know. And when I look at something like a crypto, who's the next person that's going to buy it? What are they willing to pay for it? I have a great difficulty valuing it. So, it doesn't play an especially useful role. And if I had someone who had a clear kind of preference for that type of asset, you clearly take, it may be generational, but you'd clearly take gold over a crypto.
Yeah. Michael, do you have any comments?
I agree with what was said, right? I definitely am a big supporter of the blockchain technology. I do think, I see some parallels a lot of parallels over the last year to sort of .com in 2000, 2001, right? You have this technology, everyone gets a bunch of hype around, all these stadiums get named, all the Super Bowl commercials are that, and then it blows up 6 months later. I think it will be back. I'm not going to say it's going to be back like .com wasn't changed the world that way, but blockchain will be back. I agree with all the comments about crypto. I think that was many of those coins were Ponzi schemes, clearly, right? Factually, FTX. But I think that, even some regulators have come out and talked about there is value in getting a stable coin out there for some of the examples that were talked about here. It's just going to take time for someone to really lead and whether it's the US government or another one to really legitimize one of these stable coins. Then I think you'll see some adoption, but you won't see the speculative price swings that you saw with Shiba Inu coin or the like. Yeah.
Well, I want to thank you all for joining us this afternoon. Thank you so much, Professor Kuehn, for leading the discussion, for Lori and Jim and Michael. I know there are a lot more questions out there. That's why we have financial advisors, right? So grateful to have you on, and thank you for the time that you spent today sharing your insights with us for our alumni audience. Thank you for joining us. Hope to join us again soon for one of our live events or another one of our webinars. But please stay connected to the alumni community. We appreciate your support and your involvement. I know our students value it very much. So thank you. Have a great day. And let's see, maybe we come together at the end of 2023 and see how we all did.